Hello everyone, welcome back. Pause your scrolling for a moment because the conversation around silver is about to get a whole lot more uncomfortable. Most people are still treating what's happening as if it's a routine rally, just another pop that will cool off and quietly drift back to where it started, as if the chart will politely behave and return to normal. But markets don't act politely when pressure keeps stacking underneath the surface. And right now, silver is behaving like a market being pulled in two opposing directions at the same time: relentless industrial demand that never really shuts off, and investor demand that shows up in powerful, unpredictable waves. That combination is exactly how you get moves that look irrational to anyone who wasn't positioned early enough. Before we dive in, I need to ask for something small but genuinely important. I'm running an ongoing effort to push back against copycat channels that recycle the same tired narratives and drown out original analysis. If you find value in what I do here, hit subscribe and drop a comment saying John AG, so the algorithm knows you're supporting real original work. All right, here's how today's video is going to unfold. First, I'm going to explain why I believe we're still in the early chapters of this metals cycle, even after the dramatic price action we've already seen. Then I'll walk you through how I think about mining stocks so you don't waste the opportunity by either overtrading or freezing up and doing nothing. After that, we'll get into the silver wildcard: inventories, deliveries, and what could happen if physical tightness becomes a front-page issue. And throughout all of this, I'm going to stay grounded and honest, because the biggest danger in a bull market isn't being wrong, it's being right, but getting out so early that you never actually get rewarded for it. Silver has been moving like it has something to prove. One week it looks calm and controlled, the next week it gets slammed lower. Then, almost out of nowhere, it snaps higher and forces everyone to rapidly reprice their expectations. That's why silver has earned its reputation over decades. It's the metal that rewards patience and punishes people who need constant emotional reassurance. And if you're new to this space, that's the first lesson you need to internalize. A powerful long-term trend and vicious short-term pullbacks can exist at the same time. Those pullbacks don't automatically signal that the trend is over. Sometimes those pullbacks are simply the admission fee for staying in the game. When people say we're late, they usually point to one thing: the number flashing on the screen. They look at the headline price and say, "It's already high, this has to be the top." But high prices do not automatically mean a late cycle market. High prices can mean that phase one finally broke and phase two hasn't even fully arrived yet. So let me frame this the way I frame it in my own mind. A full metals bull market typically unfolds in waves. The first wave is disbelief. That's when metals are treated like a sideshow and miners are viewed with suspicion, as if they're guilty until proven innocent. The second wave is recognition. That's when serious capital starts acknowledging the trend, balance sheets improve, and valuations stop being crushed. The third wave is mania. That's when everyone suddenly becomes a metals expert, average companies get priced like miracles, and risk management quietly disappears. Most people are acting like we're already deep into wave 3. So let me slow things down and define what early actually means in a way you can use. Early does not mean prices are cheap. Early means the public is underallocated, institutions are still hesitant, and valuations haven't fully adjusted to a higher price environment. In other words, early is a behavioral condition, not a price point. You can have a high price and still be early if participation is light and conviction is fragile. And you can have a low price and still be late if everyone is already all in and exhausted. So the next time someone says, "We're late," ask them one simple question: late compared to what? Now let me introduce a concept that fundamentally changed how I approach mining stocks: operational torque. A miner's costs are largely fixed in the short term. You've got labor, energy, maintenance, processing, transportation, and the overhead required to keep everything running. When the metal price rises, revenue increases immediately, but costs don't rise at the same pace. That gap is margin expansion, and margin expansion is what causes mining stocks to explode higher. But torque cuts both ways. If the metal price drops while costs remain sticky, margins compress quickly, and the stock can get punished brutally. So the real question becomes, how do you capture upside torque without getting destroyed by downside torque? The answer is quality paired with discipline. Quality, so the company can survive stress. Discipline, so you don't overpay, oversize positions, or emotionally react to every move. Now let's talk about valuation in a way that actually matters. Most people fixate on price targets. Silver to 100, gold to 6,000. It's entertaining, but it's not a strategy. A real plan asks better questions. If silver stays elevated for 2 years, what happens to producer free cash flow? If free cash flow grows, what valuation multiple might the market assign as confidence improves? And if that multiple expands, what does that do to the stock, even if the metal price only moves modestly? That's where hidden upside lies. Price targets focus on a single lever. Markets move on multiple levers at once: metal prices, production volumes, cost structures, balance sheet repair, and valuation multiples. If 2 or 3 of those levers move in your favor simultaneously, a reasonable investment can turn into an extraordinary return. Now, I want to inject a healthy dose of skepticism because being bullish is easy. Staying bullish without becoming reckless is the hard part. So here's the skeptical checklist I run through. What if the biggest move already happened? What if the deficit is already priced in? What if substitution accelerates faster than expected? What if recycling ramps up? What if industrial demand slows? These are legitimate questions. If you ignore them, you're not investing, you're believing. But here's the counterbalance. Even if some substitution occurs and even if demand growth cools in certain areas, the transition underway is not a one-quarter story. Energy systems, electrification, and advanced electronics are multi-year build-outs. Military and critical infrastructure don't suddenly stop needing silver just because the price rose, and investors don't abruptly abandon real assets if purchasing power continues to feel fragile. So my framework isn't silver only goes up. My framework is that the probability of higher average prices over time is strong enough to justify exposure, as long as volatility is respected. That brings us to volatility strategy, because this is how you stop being a passenger and start being the driver. I like to pre-decide a few zones. A core position I don't touch unless the thesis breaks. A trading sleeve I can trim into strength and add into weakness. And a cash buffer that prevents forced selling. That last piece matters more than most people realize. Forced selling is the fastest way to turn a good idea into a loss. So if you're building exposure, keep dry powder. Not to perfectly time bottoms, but to stay flexible when the market tests you. One of the most overlooked forces in a metals bull market is cost inflation. People assume higher metal prices automatically mean miners win. That's not always true. If diesel spikes, if labor costs rise, if reagent prices jump, or if governments increase royalties, margins can get squeezed. That's why you want operators who manage costs well and jurisdictions that don't treat miners like cash machines. It's also why, for most people, a diversified basket beats a single hero trade. Now let's talk about drawdowns, because they are inevitable. In strong cycles, you'll still experience multiple corrections that feel like the end of the world. That's normal. That's how leverage gets reset and weak hands get flushed out. You should assume there will be at least one drawdown that makes you question everything. If you plan for it, you can survive it. If you don't, you'll capitulate at exactly the wrong time. Here's a practical checklist you can actually use when evaluating a miner. First, does the company have enough liquidity to survive 12 months without ideal conditions? Second, are costs stable? And does management discuss them clearly? Third, is the share structure reasonable, or is dilution the hidden tax? Fourth, does the project have a clear path to production, or is it just a science project? Fifth, are there catalysts in the next 6 to 18 months that can change perception? Sixth, are there geopolitical risks that could erase value overnight? Seventh, is the valuation already pricing in success, or is there still a discount? That checklist won't turn you into a genius, but it will keep you from stepping on the obvious rakes. Now let's run a quick scenario map for 2026, because this keeps you mentally prepared. Scenario 1, equities grind higher, the economy muddles through, liquidity stays reasonable, and metals trend upward, while miners slowly re-rate. That's a steady, profitable environment with viable pullbacks. Scenario 2, equities correct sharply, correlations spike, metals pull back too, and the market delivers a violent shakeout. That's painful, but it can also create the best entry points for the next leg higher. Scenario 3, a confident shock hits, maybe debt, currency, or geopolitics. In that case, metals can gap, premiums can surge, and the market can move faster than your brain can process. That's the scenario where you don't want to be scrambling for exposure at the last second. You want to already be positioned, even imperfectly. Here's another truth most people miss. In real bull markets, the most frustrating periods often come right before the biggest moves. So if silver starts chopping sideways and people get bored, pay attention. That's often when energy is quietly being stored. Quick mid-video reminder. Check the description for bonus resources, including the premium WhatsApp channel and channel membership options. Members-only videos exist for a reason. They're for people who want deeper research, longer breakdowns, and scenario planning that doesn't fit into a public video. Now let's address another common trap: obsessing over calling the exact top. Trying to nail the top is an ego trade. It feels great once, but it usually costs more than it earns. You sell too early, watch the trend continue, then buy back higher out of frustration. Instead, I prefer scaling. When silver enters clear euphoria, I trim into strength. When miners are priced for perfection, I reduce risk. When low-quality names are rewarded like high-quality ones, I get defensive. That's not fear, that's cycle awareness. Let's refocus on the core objective. The goal isn't to win online debates, the goal is to make sound decisions, and sound decisions require humility, patience, and a plan. So I'll ask you directly, what's been your biggest investing mistake so far? Buying late, selling early, or holding the wrong things too long? Share it in the comments. And if you've had something work, share that too. Success spreads when people talk about it honestly. When I look at how many mining equities are still valued relative to their cash generation potential, I see a market that hasn't fully priced in what higher metals could mean. That matters because price is only one engine. The other engine is the valuation multiple the market assigns to earnings and free cash flow. And that second engine is where surprises often live. So let's talk about free cash flow, because this is where speculation turns into reality. A miner isn't a meme. It's a business that extracts, processes, sells, and ideally produces cash after all expenses. In strong price environments, capable operators don't just survive. They pay down debt, build cash reserves, expand projects, buy back shares, and pay dividends. That's how a miner evolves from a gamble into a compounding machine. That's why I keep coming back to three filters: balance sheet, margins, and pipeline. What the company could look like in 2 to 4 years, not 2 to 4 weeks. When those align, you're not hoping, you're positioning. And yes, I can already hear it, but silver is volatile, absolutely. Silver isn't the metal you marry for stability. It's the metal you date because it can change your life and also break your heart. It's both. Pretending otherwise is how people get wiped out. So ask yourself this honestly. Are you trying to be right on every candle, or are you trying to be right on the cycle? Those are completely different games. If you aim to be right on every candle, you'll overtrade, chase moves, panic sell, and buy back higher. If you aim to be right on the cycle, you accept messiness. You plan entries, adds, trims, and you stop letting intraday noise dictate your emotions. Now let's zero in on miners, because this is where returns either multiply or stress does. Mining stocks are leverage. They're leveraged to metal prices, costs, execution, and sentiment. That's why they can move 3 to 5 times faster than the metal on the way up, and why they can drop faster than you expect on the way down. Treating them like blue chip stocks is the number one mistake people make. The second mistake is buying miners like lottery tickets. No thesis, no understanding, just a chart, a name, and a click. When the stock dips, there's no anchor, no conviction, so they sell at the bottom and blame the market. To avoid wasting a bull market, you need to own your thesis. You buy a miner because it has a real path to cash flow, or already produces it and can expand, because the balance sheet can survive, because management isn't endlessly diluting shareholders, because the jurisdiction is manageable, because valuation leaves room for upside. That's the story, and story is not hype. Time horizon matters more than most people realize. A development project doesn't become a cash machine in 1 quarter. Permitting is slow, engineering is slow, construction is slow. If you expect monthly gratification, you're setting yourself up for misery. Producers respond faster. Developers take longer but can offer outsized upside. Explorers are highest risk and highest chaos. That's why I prefer a layered structure. Metal exposure, quality producers, mid-tiers with growth, developers with catalysts, and a small explorer sleeve if you have the temperament. That structure keeps you standing when one layer gets hit. One more bull market trap: screen number panic. You buy at 5, it goes to 7, you feel brilliant. It drops to 6, and suddenly you feel betrayed. Nothing changed, only your emotions. If you can't handle pullbacks, you'll never hold the move that creates life-changing gains. I use 2 exits: a thesis exit, what proves me wrong, and a panic exit, what stops me from doing something stupid in the moment. That separation matters. There's a scenario where silver drops hard, stops get hunted, headlines scream the bull market is dead, confidence collapses. Then, if physical tightness remains, silver rebounds from a higher base, and the next leg begins. That's how cycles remove weak hands. That's why fear-based plans fail. Metals and equities moving together lately doesn't invalidate the thesis. It reflects liquidity and sentiment. When markets panic, correlations rise. Ask the right question. Did supply-demand fundamentals change, or did sentiment temporarily shift? Now for the silver wildcard, inventories and deliveries, silver is embedded everywhere: electronics, solar, autos, medical, industry. That demand quietly drains supply. Investment demand comes in waves. It doesn't take much to stress a market not designed for a stampede. Prices rise, users thrift, substitution appears in limited areas, and institutions source metal quietly. Declaring certainty is a mistake, but ignoring stress signals is worse. Psychology moves prices faster than spreadsheets. If silver tightness becomes serious, governments won't start with dramatic headlines. They'll apply pressure quietly, incentivizing recycling, supporting domestic processing, funding strategic projects. Keeping industry running can create price spikes, engineered pullbacks, and volatility that feels irrational. Your plan must assume that. Metals don't require collapse to perform. Inflation, fear, currency debasement, even strong markets with abundant liquidity can all support them. Don't tie your thesis to a single disaster. Focus on confidence, purchasing power, and real supply chains. For physical stackers, physical is about insurance and optionality, not dopamine. It doesn't multiply itself. But miners can, if used strategically, increase ounces over time through disciplined profit-taking. That's how volatility becomes accumulation. Quality first, then the edge. Catalysts, ramps, turnarounds, cost improvements, permits, financings. The market is short-term. If you can think in 2 to 4 year windows, you can buy future value before it's acknowledged. Constantly checking positions will sabotage you. Mining stocks test patience by design. Rules matter, sizing, diversification, add and trim plans, and clarity on why you own each position. Risks exist. Risk-off events, rate spikes, currency shocks, policy changes, production surges, substitution. That's why plans must survive both directions. Ignore narratives, track fundamentals. And here's the cliffhanger. A sudden shift from price to availability. When buyers stop asking how much and start asking how soon, everything changes. If silver gaps higher while you're underexposed, will you chase or regret? Your honest answer tells you what to do now. Share your wins, share your struggles. Check the description for bonus resources, including the premium WhatsApp channel, membership access, and deeper members-only research. Don't waste a bull market. Stay aligned with the trend. Scale responsibly. Rotate intelligently. Respect quality. Manage size. If equities stay strong, miners can benefit. If equities correct, miners can get hit regardless. Funds sell what they can, not what they should. Proper sizing turns pullbacks into opportunity instead of disaster. My stance is simple. Fundamentals and positioning still support higher prices over time, but the path will be violent. That violence is the cost of the opportunity. So answer these 2 questions in the comments. Do you prefer physical silver, miners, or a mix? And if silver drops 15% in a week, are you adding, holding, or panicking? Silver is a market of extremes. Miners are leverage. You don't win by predicting every move. You win by building a plan that survives volatility and stays aligned with the cycle. Support the channel by subscribing and commenting, John AG. Check the description for bonus resources and members-only content. Share your success stories. Your win might help someone else hold through the next shakeout. Most people don't miss bull markets because they never bought. They miss them because they got shaken out right before the payoff. Don't survive the volatility just to hand the profits to someone with more patience. Take care of yourselves, take care of each other, and I'll see you in the next one. And a final disclaimer, this content is for educational purposes only and reflects my personal opinions. It is not financial advice. Do your own research and consider speaking with a qualified professional before making any investment decisions, especially in volatile markets like precious metals and mining stocks.